Welcome to This Explainer. While today we're going to take that super intimidating legal reality of what actually happens to your finances after you pass away, and we're going to break it down into a clear, fascinating, step-by-step process. So if you've ever found yourself wondering how an estate is actually settled, you are absolutely in the right place. First things first, we've really got to shatter this whole myth of instant inheritance. You know how Hollywood loves to show the family all gathered in some dark wood-paneled room reading a will, and then boom, they just immediately walk away with bags of cash or the deed to a brand new house? Yeah, the reality is completely different. An executor can't just hand out money or transfer property on a whim. There is a deeply rigid, legally mandated process that literally has to be followed to the letter. Enter our hero, or, well, maybe our strict auditor, the liquidation and distribution account. Most people just call it the L&D account. Basically, think of it like the ultimate highly structured corporate financial report, but it's built specifically for a deceased person. It accounts for absolutely every single cent of an estate, and it definitely doesn't just sit in a drawer gathering dust. It gets formally submitted to the Master of the High Court. Okay, so here are these strict, non-negotiable sections that make up this incredible document: the master document, the main balance sheet, the cash flow checkpoint, the delivery schedule, taxes and time gaps, and finally, the final sworn oath. Let's jump right in. Section 1, the master document. Here is where we establish the absolute authority of the paperwork we're looking at today. The crucial point for us to remember is that this isn't just some casual spreadsheet an executor throws together on a Sunday afternoon. No way. It is a strict legal requirement mandated under Section 35 of the Administration of Estate Act in South Africa. The Master of the High Court acts as the ultimate watchdog here, and they have to formally approve this document before a single heir sees even a single cent. It's all about total accountability and making sure the law is executed perfectly. Moving right along to Section 2, the main balance sheet. This part builds right into what's known as the liquidation account. And what's really fascinating here is how cleanly it juxtaposes everything the deceased owned against absolutely everything they owe. On the one hand, we've got the assets section. This is a neat, comprehensive list of all property. We're talking houses, cars, shares, furniture, literally even the cash found in a wallet. It's all recorded at the official valuation at the time of death, which gives us the gross value of the estate. But then, on the other hand, comes the liabilities section. This is the reality check. It lists all pre-death debts, things like credit cards and home loans, right alongside the immediate cost of passing away, like funeral expenses. Now, there is one specific liability that always seems to catch people's attention. Included in those administration expenses is the executor's specific cut, which is legally capped at 3.5% of the gross value of the assets. To put that in perspective, winding up an estate is a massive amount of work, and this percentage is just the standard professional fee for that service. It gets pulled directly out of the estate's funds before the heirs get their share. All right, Section 3, the cash flow checkpoint. This brings us to a very common, very real problem. What if the estate has a beautiful, entirely paid-off mansion, but absolutely zero cash in the bank? This is exactly where the recapitulation statement comes in. It's a brilliant, straightforward cash flow checkpoint. It compares the total actual cash received by the estate against the total cash expenses and debts that actually need to be paid out. Why does this matter? Well, if this statement shows a cash shortfall, the executor has a huge problem on their hands. You can't exactly pay off a credit card company with a corner of the living room, right? This statement dictates whether the executor is going to be forced to sell off hard assets, like the beloved family home or a car, just to generate the hard cash needed to cover debts before they can hand anything over to the heirs. Which leads us to Section 4, the delivery schedule. Once we actually survive that cash flow check and all the debts are fully paid off, the exact remainder is finally known. This part acts as the official delivery schedule, formerly called the distribution account. It's a rigorous, incredibly detailed list that spells out exactly who gets what. It lists the names of the heirs, their ID numbers, their precise relationship to the deceased, and the exact asset or cash amount they are inheriting. Crucially, it also has to state exactly why they are legally entitled to it. Is it because of a specific clause in a valid will? Or, if there was no will, is it dictated by the Intestate Succession Act? Literally, nothing is left to guesswork. Every single distribution requires a rock-solid legal justification. And honestly, this brilliantly illustrates the real core engine of the L&D account. Just look at how these first three vital components lock perfectly together in a logical chain of cause and effects. Step 1 outlines total assets
minus liabilities. Step 2 drops in to check if there is actual physical cash to pay those liabilities. And only then, Step 3 allocates the remaining finalized balance to the rightful heirs. It is just a perfectly engineered sequence to make sure no debt is left unpaid and absolutely no heir is shortchanged.
Next up, Section 5, Taxes and Time Gaps. We have to face the realities of bureaucracy here because winding up an estate is not just frozen in time the moment someone passes away. It takes months, sometimes literally years. And during that waiting period, well, life goes on, and so do finances. The income and expenditure account tracks all this mundane but completely essential financial activity that happens after the date of death. So, for example, if the deceased owned a rental property, the rental income still flows in. If they had a bank account, interest still accrues. But on the flip side of that coin, the estate still has to pay the local municipality for rates and taxes on the house, and it absolutely must keep paying insurance premiums so the car doesn't go unprotected while all the paperwork is being processed. Briefly, we also need to account for things the deceased held but didn't actually own themselves. The fiduciary asset account handles property the deceased was managing on behalf of someone else, maybe through a trust or special legal setup like a fideikommissum. Because these assets didn't actually belong to the deceased personally, they absolutely cannot be distributed to their own heirs. This specific account safely separates those assets out and makes sure they are handed over directly to the next rightful successor. It keeps the estate's money perfectly segregated from someone else's money. And then, of course, there is the taxman. We have to calculate estate duty, which is effectively a death tax, for the South African Revenue Service, or SARS. Currently, the specific tax only kicks in if the total net value of the estate crosses this exact threshold, 3.5 million rand. So to figure that out, the L&D account includes the estate duty addendum. This is basically the official calculation sheet where the executor calculates the total taxable value of the estate, then carefully subtracts any legally allowed deductions. For instance, money left to a surviving spouse is generally tax-free. Whatever is left over is used to determine the exact tax owed to SARS. The government makes absolutely sure it gets its exact required share before the Master of the High Court will allow the process to close. Finally, we arrive at Section 6, the final sworn oath. Let's see how all this meticulous balancing actually builds to a dramatic climax. After all the spreadsheets, the cash flow checks, and the endless tax calculations, we arrive at the executor's certificate. This is the final, legally binding signature page. Standing right in front of a commissioner of oaths, the executor signs a sworn affidavit. They are literally putting their professional and personal neck on the line, declaring under oath that this massive document is 100% complete and accurate. They are swearing they have hidden nothing, disclosed every single asset and liability, and acted with absolute honesty. As we wrap up this explainer, I really want you to think about what we've just uncovered. The liquidation and distribution account is an absolute masterpiece of financial accountability, designed to bring order to the chaos of a life left behind. But the ease with which an executor can actually build this report depends entirely on how organized the deceased was in life. So, take a second and consider your own preparations right now. If your estate was audited tomorrow, would your loved ones face a smooth, organized transition or a totally chaotic, stressful audit? It's a pretty powerful reason to get your affairs in order today. Thanks so much for joining me on this deep dive.